traditionally are in it for the long term, there's a pretty good chance whatever comes down must go up. But over a long, very long time horizon, it's a very general statement what I made, but it's important to just consider all of these factors when you're sort of crafting these things up.
Yeah, exactly. And when you think about something like, I won't use the recession word, I guess I already did, but when you think about something like that, right, when there's a real downturn, right, and then that downturn is in many ways. So you're going to potentially have a lack of employment or a loss of employment if it really hits the economy and there's layoffs. So you might feel it in your personal income where you've been temporarily laid off, right? So there's already that point. And the portfolio could be down too, right? Because so you might now need income badly because you've lost the personal income and the portfolio is down and you don't have those safe parts in the portfolio to mitigate you. So I'm always thinking about risk management. I'm not a pessimist. I'm actually an optimist. I really think that the markets are a great wealth creator longer term. But you have to think about these contexts because we're seeing it today and we see it every several years where something like this, a dislocation happens, and then also life happens. So you want to make sure that you've got plans in place for when these things happen to not have to reach in and sell a stock at a low point because you just have to, right? Like you want to have some plan around that.
Yeah, I mean, it's prudent practice, right? I mean, it's really good to make sure that, hey, we are always thinking about preservation, risk management as far, when you're in the space to invest and grow, it's important to make sure you're able to preserve what you're building at the end of the day because things can go sideways pretty fast, and if you're not prepared for it, it can actually derail your whole wealth building process just in general at the end of the day.
Absolutely,
Just if you were to maybe take a few general principles just in general, I mean, I know there's the Warren Buffett saying, what is it? Be greedy when, be fearful when others everybody's are greedy.
Yeah, for sure.
What do you typically see, when it comes to that just in general, like, do a lot of people adhere to it, or do you sometimes see people's emotions just getting in the way to sort of really? It's almost like the herd mentality happens. I mean, it happened in the real estate space quite a bit over the last little bit. But what do you typically see out there, in the markets just in general?
Yeah, in terms of those principles are so solid, and I think like Warren Buffett is just a great mentor and a role model for kind of how you should invest longer term. There's another quote from one of the Rothschilds, Baron Rothschild, but he was, invest when there's blood in the streets, which is a brutal quote, but basically the idea of when things are really, really bad, that's actually when you should try and put some money to work because you have to have this positive outlook that things will get better. And then in that case, you're going to do yourself and your family a real benefit by building up assets at a time when prices have come down temporarily, right? So in terms of the principles that people should think about so going back to the emotional side of it, right? Like it is easier said than done to avoid your emotions in these moments, right? So I think a plan is so important. Even just an investment plan. So you'll have the financial plan, which kind of says, you can, if your investments grow at 5% a year, you'll be okay. And then the investment strategy might be, this is your portfolio. We've qualified you as a medium risk client. We've had that conversation with the client. We've figured out what their liquidity needs are, what their income needs are, and this is the plan now. It's in a document. It'll be an investment policy statement we'll usually have. And then we'll have kind of some buffers in place for parts of the portfolio which will provide safety. So have some fixed income in there. But it is, like the emotional part does creep in for sure. You'll see the herd mentality. You'll see a lot of mania and following the crowd, FOMO for sure, right? Everyone has this stock, I have to have it as well.
But even on that note, I always said, like, if somebody is telling you to buy something because it has gone up significantly, what the person who's now going to act on that comment, but they don't realize is the stock, maybe they bought it at a dip, the previous person, and the stock has already grown, and maybe it's not going to grow at the same pace as what the person's, the previous person who bought it, their growth has gone. You might be too late to buying that stock, but yet you're still acting on the instructions just because somebody else did it, right? Like, that's very common. Does it happen from time to time?
Of course, like looking at the value of what you're buying is as important as just getting invested or, getting invested in the market, I think is a good principle for someone starting out. Just if they're not invested yet, like bite the bullet, get invested, right? But yeah, the risks build up when we get these periods of the market kind of having some mania, everyone following the same 3 or 4 companies. We saw that during 2022, 2023, 2024. A few companies led the market very strongly. And then I think that's where it really just it goes back to the principle of diversification and just making sure that there's going to be a time when these companies have really expanded in their value, right? We use a metric called price to earnings, which is just how you would think about the value of a company, right? So let's say the historic price to earnings is 20, now it's 25. So that means it's become quite expensive, right? So you're buying it now at a high price. So you should expect that at some point that might revert. You might have a reset. The stock might come down. So the price that you're getting in matters. Like think about valuation, and then going back to times like this when there's emotions creeping in, we look at it and say, well, these were good investments for you a year ago when the valuation was higher. Now we're buying these great companies at a discount. It's like a sale, right? So why not buy even more now, right? If you have long-term horizon, if you can kind of turn down the noise slightly and think about this as just like a sale. If we're going to the grocery store, right? I love a sale, right?
Yeah,
so
absolutely.
Inflation has made grocery shopping a hot topic in the household, right? And we do shop around. We look for a sale. So it's the same thing, right? You want to buy a piece of a good company, and it was a good company yesterday, and now the price is down. It's an even better company now, 100%. Right? So go ahead and try and act against that emotional urge and buy. You'll be thankful.
Yeah, absolutely. And if we can just maybe touch base on a couple of things on this note, just because I think it definitely correlates, but it's not just timing the market, it's definitely time in the market, obviously. That in combination with obviously compounding interest in the sense that, hey, the earlier you start, the better it is as you sort of grow over a long period of time. And the third part of it is dollar cost averaging. Just if we were to think about those kind of things, how would you sort of sum it up just in terms of if somebody wants to just start, what are some basic next steps that somebody might want to look at? Of course, do research. It's not meant to be investment advice or anything like that, but what are some next steps that you would definitely say to someone?
Yeah, I mean, I think the dollar cost averaging part of it is the right approach because we know now that prices have come down a little bit from where they were at the end of last year, but I also don't know if they'll go up tomorrow or they'll go down further, right? Like, it's just hard to see through not just this administration, but I think at any point in history, just like what will happen day to day in the market is anyone's guess, really, right? We have some ideas, but the market also moves independently of the economy sometimes, right? So the best thing is have a plan. If you have, say, $100,000 that you want to get into the market, I wouldn't throw it all in on day one, because you will catch some periods like we had in March, like in April, where the markets are down, and you'll take advantage of that now systematically, and you'll buy at lower prices. And I don't know if the next down month will be May or June, or we won't have a down month, but that way, if you're investing $10,000 a month every month, if we do get some volatility, you're just taking advantage of that. You have a plan to be systematic. And that way you're not timing, right? Having a plan to get in the market, 1/10 a month over 10 months is not timing, but it does take advantage of volatility in a systematic way. But then the benefit is, of course, now you're in, and if you keep doing that, if you keep getting your annual bonus and allocating it back into the market, trying to do it systematically, maybe every paycheck you kind of dip out a little bit.
Good habits.
That is a really good habit. I think the rise of passive, and I think there's maybe some pros and cons. We can get into that if you'd like, but the ease of access for someone to just get a paycheck and just to allocate a portion to some ETFs directly is a great wealth builder, right? Your dollar cost averaging in. You're not thinking about it. It's coming off of your pay, and you're paying yourself first. I'm sure you know that.
100%.
It's going to the market immediately, and then you, just through the fact that you get paid every 2 weeks, your dollar cost averaging, you're catching some low weeks, you're catching some middle weeks, some high weeks, but you're building this kind of compounding engine over time. And I have some great examples from when I was working at the call center, even at the banks, and I would just see some portfolios of people that had built kind of, in some cases I would call it a simple portfolio. They had some Canadian companies, some US companies, some fixed income, but it just had this long time horizon.
Yeah.
You could tell that they started 10, 15, 20 years ago.
Yeah.
And I always love seeing the book value versus the market value. Right? So the book value is like, what did you put in and what's it worth today? And you see like, they put in 200, it's now worth 400, 500, 800. And the dividends are 40,000 a year, and they're living off just the passive income on it. So that is, where you want to get to, and it really starts when, for a younger listener, it starts when you're in your 30s and you're just starting now. You're not at those numbers yet, but you'll be so thankful when you're, your future self, when you're 65, will look back and think like, wow, it's so good that I did that.
Yeah, I mean, I'll even tell you, like, personally, like, I was 16 when I started working at McDonald's many, many years ago. And of course, my dad worked at one of the major banks in Canada, and he obviously knew everybody at the branch level. And they made me do these $25 packs into non-reg investments. So you were 16, so you couldn't do any of the reg TFSA or any of that stuff. And I hated it with a passion, just because when you're 16, you work at McDonald's, $25 biweekly is a large amount. And this was obviously 15, 20 years ago. But all of a sudden, fast forward, because it was also an account that I did not have access to, just because I didn't know about online banking and all that jazz, that then. But all I knew was money was coming into the account, but on that payday, so bi-weekly on a Thursday or a Friday, that $25 gets deducted. That part of it I knew. But fast forward 7, 8 years later, all of a sudden, when we were looking at potentially purchasing a home and things like that, there was an amount that was sort of built up. I mean, hey, I didn't even think about it as an active investment, but that's when I truly understood really the power of compound interest, just in general. Like, hey, something that's growing, of course, it's not like crazy amounts, but something that grows over a period of time, and at least it's out of sight, out of mind, and you just kind of just make sure it saves up, whether it's for a rainy day as an emergency fund. I mean, it shouldn't be the case, but or if you really need it towards a particular purchase, you're able to plan for it, and then maybe you're able to action it on it properly.
I would say out of mind, I think, is another great investing principle to kind of keep you systematic and just have the emotional part of it turned off. Right. So a great plan that I think a lot of people don't utilize well enough is their group RSP through their employer. Right. And as you would know, there's in many cases you'll have 3% taken off of your paycheck. Your employer will match 3%, and then whatever it's being invested in will have some compound growth over time. So just a very simple example. Let's say it's 3%. Your employer is giving you 3%, right? Your starting return is a free 3, right?
Exactly.
And then the RSP is not invested in money market or just cash, right? You're putting it into something which will compound over time. Let's call it a balanced portfolio. Let's say that's going to grow at conservatively 5, right? So now you're getting 8. Right, and 8% compounding will double in, I don't know what it is, like less than 10 years, right?
Exactly.
And then if you throw more into equity, even more so. But the fact that you're getting that initial starting point of the +3, people, going back to being early in your career, you want to have more cash, right?
Exactly.
Like you just don't want your paycheck to be curtailed. It could be this, but now it's that -200 because it's going to some account somewhere. But then all of a sudden you have to pay for a wedding or buy a house, and then you look back at that account and you're thankful that it's grown to some tens of thousands, and it's because you didn't touch it.
100%. And I always say this as well, just when we have discussions, very open discussions with the clients, like year over year, you might be getting a bonus, you might be getting an increase in your pay, etc. Like, just be really mindful of that lifestyle creep that obviously gets in somebody's way. I mean, if you lived a lifestyle at $100,000 a year for XYZ years, and all of a sudden now your income is 120, 130, whatever it is, maybe you had a change in environment, job, your lifestyle does not have to jump to that 130K a year. If you can still maintain to live at that $100,000 lifestyle, maybe you're able to invest that extra amount that you're making into things that can be meaningful from a long-term perspective, right? And just really having that view and be able to ensure that your lifestyle doesn't allow you to continue to deplete your savings and investment strategies that are out there.
Yeah, lifestyle creep is a real thing, and it's a killer for some financial plans. Like you'll see, I worked on some financial plans where it's pretty modest income, like someone's making $70K a year or something, we'll call it that, or even as a family, but they've kept their their expenditures in a really modest range. So there's this good spread in between income coming in and what's going out. So that's really compounding now. Whereas you might get someone that's bringing in 400K, 500K a year, but the lifestyle creep has led to the fact that there's none of that being saved. They're actually going into debt every year. And I have some cases I'm thinking of. I won't bring any examples up, but where, I mean, things like, just servicing multiple properties and, I think people should enjoy the fruits of their labor, and they should go out and go vacation and whatever, adds value to you and your family. But it doesn't mean that because I made $2 more, I have to spend those $2 more, right? Like there's a way to scale that appropriately where you're now building a nest egg at the same time as you're having fun, right?
100%. So just to quickly touch base on along the lines of tax implications in terms of investment. So we won't get into it too much, but I've always believed, hey, there's actually 3 different ways to think about, in terms of from a taxation perspective. There are asset classes that are never taxed, obviously. There are asset classes that are taxed, but maybe not today, but maybe sometimes in the future. And there are asset classes, or not asset classes, there are vehicles that are then taxed on a yearly basis, right? So can you talk to us a little bit about some of the different asset classes or asset types and how they sort of fit into somebody's plans, whether it's TFSAs, RRSPs, that kind of stuff?
Yeah, for sure, One, I mean, we talked earlier about equity and fixed income, so I'll keep it on those two to start, right? Fixed income, so let's just say it's a bond, it's a Government of Canada bond or something. You're getting income in the form of interest. And I'll assume for this example that it's in a taxable account, right? So you're getting taxed on that full amount. So even if the kind of top line amount looks nice and attractive, let's say it's 7% or something, the entire amount is taxed. And let's say it's the highest rate in Ontario, I'll just assume 50% for this example, right? Absolutely. It's going to get cut in half. So 7% becomes 3.5% after tax. So if you compare that to, say, a dividend-paying stock, and maybe the dividend is only 3%, and there's some capital appreciation, and maybe that capital appreciation will just be conservative and say it's only 2% or something, but that's deferred. You're not paying any capital gains on that until you sell it down the line. You're paying tax on the dividend income, which has a preferred rate. There's a dividend tax credit, as you know. So after tax, the kind of 3% dividend-paying stock ends up being better in this example, right? However, the fixed income investment in your RSP is very powerful, right? Because now that whole thing is sheltered. Get the 7%, and there's no tax taken off the top. So we call that asset location as opposed to asset allocation, right? Where are you putting your assets?
100%.
Right? So if you have a balanced portfolio, you have some equity and some fixed income. Maybe the dividend-paying stuff, you don't want to jam that into your RSP and take up all that room because that's really nice to use for your fixed income, right? If you have a good allocation to fixed income. So use that as well. The tax-free account is, as you know, totally tax-free. So if you have some more kind of longer-term, more growth-oriented equity-based investments, if you have some private stuff in there, like private equity, that might have a long lockup and long time horizon, but that could really compound really well over time. Your TFSA is great because then you look at that in 10 years, you have a big capital gain. You're not paying any tax on that. The whole thing is tax-free. And then the non-registered is kind of the spillover. So you can't, there's limits. You can't use those accounts for everything. So everything that can't fit in there should go into your non-registered account. But ideally, it's stuff that's more tax efficient. It's not the fixed income, ideally, mortgages and those kinds of investments. So it's all important to think about the return after tax, and then how you use your accounts to maximize that is so important.
Just because we don't always think along the lines of after-tax rate of return all the time, but it has a huge impact in terms of what the net return is for somebody at the end of the day, and it's important. So to your point, so it's not just about is it a TFSA or RSP or a non-reg account. It's also you got to think about if it's a TFSA, is it better to have an equity portfolio there or a fixed income portfolio versus maybe in an RRSP, a fixed income portfolio might actually be deferring that full 100% of the taxes at the end of the day, right? So
especially if you're in the higher earning tax brackets, right? Like if you're already, you're going to give away half of your marginal tax rate, half of your marginal income to your tax rate. So it's so important then to be mindful to optimize and to because people do their analysis at the top level usually.
Yeah.
7% is better than 5%. I want 7%.
Yeah.
Right, but that's before tax.
Of course.
After tax, now you're actually better off at the 5%.
Sure.
So it just takes a little bit more
Yeah.
kind of analysis. Yeah.
Yeah. So let's just zone out a little bit at a different level, and now also talk about, hey, what are some difference? Because you hear about capital markets, which is more at a retail level, which is what a lot of people are familiar with, which is your stocks, bonds, stock markets, and all of that jazz. But there's also something called the private equity market. Can you maybe talk to us a little bit about what the differences are, and two, what are some of the risks with the private equity, risk and rewards within the private equity market just in general?
For sure, yeah. So the public markets is what people generally know of, what we just defined earlier, the equities and the fixed income. Those are publicly accessible. You can go on your online trading account and buy a share of a stock. The private markets, and it's private equity, is also things like private debt. There's private real estate. So if I just kind of step back for a second, the private markets are, you're investing in things like debt and equity that are private. So it's companies that are not yet public, or that will never have an intention of being public, right? There's many very successful middle and large size companies that don't want to ever go public, right? So there's a great kind of pool of companies there that you can't access just through the public markets only, right? And then when you think about it from a personal context, everyone's had, or not everyone, but many people's first investment is their personal home, right? You're taking a leverage bet, you're potentially getting a mortgage for 70% of the home's value, right? And you're buying private real estate. And people have some comfort with that because we've all done it historically, and you raise your family there, and it's not just an investment. So if you think about that as private real estate, that can get expanded now to, okay, I have my personal home, but I can also buy an investment property. That's part of the private real estate portfolio. And then as you scale up, if you're a pension plan or an endowment plan and they have billions of dollars, they can buy a portfolio of apartment buildings, for example, multifamily real estate. They can buy, commercial real estate for industrial properties, Amazon fulfillment centers, and that kind of thing, data centers, seniors' homes, student housing. It really crosses a wide spectrum, right? Commercial properties, office buildings. So, real estate, everyone kind of has this good knowledge of the starting point. And it actually makes sense intuitively, right? If I'm going to buy an investment property, let's get a good location, right? Hopefully we can get it occupied. People are paying me rent, and then I'll hopefully sell it in 5 or 10 years and make some money off it, right? It's basically that same thing, but you just now scale that up. So it's apartment buildings, but it's the same idea. You want to have a well-located apartment building where you can get occupancy. So that as an asset class, I think makes intuitive sense. Private equity is just the private version of the equity market, right? So we all understand you can go buy shares of a company online, but companies that are private, they haven't gone public, so they don't have their shares available for purchase by the average client. So these markets are, I want to say, a little more exclusive, just because they're open to typically institutional investors only. The threshold to invest in some private equity funds is sometimes quite high, like in the tens of millions in some cases. So they really make it accessible to what they call accredited investors or institutional investors. And then there's kind of layers below that in terms of the private market. You can get quite nuanced. There's private mortgages, private infrastructure, and all kinds of things. But essentially, it's this whole world of investing where it's not public. And if I was just to step back and say, like, what's the benefit of it, right? So I talked about fixed income potentially doing well when stocks are not doing well. So you get that balancing act there. That doesn't always work, right? I'll give you an example. 2022, if I look at the U.S. market, for example, the S&P that year was down 18%, and then the 10-year government treasury, which is like your benchmark, really safe fixed income investment, was down 18% as well, right? So that was a year when your safety was down, and then your growth was also down. So you didn't get that, what you would hope for. And then again, to our example, if in that year you had to sell something, you needed to pay something off, you had no place to access to get kind of safe capital that was protected. So alternative investments or private investments are not correlated to those two markets. They'll move differently. You think about your real estate example again, right?
Sure.
If I have a property somewhere in Durham and I have tenants that are paying me rent, whatever's happening in the market today with tariff negotiations and tweets and headlines will not impact the fact that my tenants, they're paying me rent and I'm collecting a paycheck and the property's going up in value over time, right? So it is like that, where it's just not tied to the public ups and downs. And the same thing goes for private equity, right? It's tied to the economy, of course. If the economy suffers, then public and private suffer. But sometimes public markets kind of have a life of their own, and they'll go up and down based on rumors, right? Based on something that was said on literally a tweet will come out, the market will move, and then it'll move back, right? And then that won't happen with private equity, where that's just, what are the cash flows of this business? We're going to try and sell the business in 10 years or whatever it is. So the benefit is this fact that it's not correlated, right? If you want now 3 parts of the portfolio, fixed income, equities, and then we'll just call it private investments as a bucket. Now you have one part which is not moving the same way as these two parts are moving, and you just get even more diversification benefit. Maybe the downside of it is it's typically illiquid. It's
not as liquid as
exactly. I mean, that would be very obvious for the home example, right? If I want to cash out my home, I can't go sell it immediately. Well, sorry, but same thing goes for a private business, right? You can't just go sell your business tomorrow. It takes some time. But the trade-off is there's a thing called a liquidity premium. So we should, because we're giving up liquidity, get a better return as a result, or a decent return. So if you can stomach the fact that some of your portfolio you can't access immediately, then it is great from a long-term perspective to have that part of your portfolio built in. At any one time, people don't typically need their portfolio to be 100% liquid, right? At any one time, and some portion should be there to cover emergency spending or something that might pop up. But you typically don't need to have the whole thing available to cash out tomorrow. And then that's when you can think about what's an appropriate allocation to the alternative markets. It's typically reserved, I should say, for accredited investors. So typically it's higher earners. I believe the household threshold is over $200,000 in income. They'll have you fill out some forms to attest to that. Or you have investable assets of over $1 million. So you can't just buy a private equity fund as a person starting out. So you have to be somewhat accredited, somewhat sophisticated, we'll call it. But once you hit those thresholds, then you have this new world open to you.
And it's just really to protect the investor, right? Like somebody who's built XYZ asset or net worth might be in a position where they're able to invest into these uncertain type or non-conventional instruments and be able to stomach the risk that comes with it at the end of the day.
Exactly, and I think it just makes sense for, if you look at those tests, right, you're making over $200,000 a year or you have $1 million in investable assets, they're just saying that if you can't access this private investment, you're probably okay, right, because you have the kind of capital built up around you. But if you're just getting started and you really need your investments in case something happens, maybe it's not great to pour in all your money into private equity because that could get locked up in some cases for years. The typical timeline is like 10 years. Right? So you might not be able to get something in year 2 or 3 or 5. So
perfect. So we focused a good chunk of our discussion, obviously, within the capital markets or public markets first. We slowly, spoke about some of the private markets, just just at a very high level. Let's even zoom out even further. So if we were to now because at the end of the day, I know you and I both, you actually spend quite a bit of your time, in the public market space and to some extent, obviously private equities. But if people were to think about asset classes in general, so I'm now talking about any kind of asset classes instead of just the markets itself, everything from crypto to asset classes to real estate to everything else. What are some really the major different types of assets traditional household or even sophisticated investors hold, just at a very high level? So other than your public markets, what are some of the other different asset classes?
Yeah, I mean, it's evolving because you mentioned crypto, and that is, I don't even want to say new because that's now been over 10 years if you look at when the Bitcoin paper came out. So there are things like that. It's another alternative investment, you can call it. It's alternative to even traditional alternatives. It's like alternative squared or something. Crypto would be one of those things, or digital assets, what we'll call it, kind of more generally. Art is another thing, right?
Yeah.
People can think about diversifying in high quality art, which is, it's got its own market for. Those are very esoteric, right? Things like, even like jewelry and watches
Gold
and that kind of thing.
like that.
Gold,
Yeah.
exactly. Buying physical bullion. I'm okay. A portfolio should be accessible and liquid, because we just don't know what life will throw at us.
Of course.
My general rule is you want to have about 60% of your assets in something that's accessible and public, right? So that could be stocks and bonds. It could be something that has those attributes, maybe has some alternatives in there, but it's still liquid. But as you start to lock up more and more away into things like crypto or things like jewelry or something, you might get into a situation where those markets are taking a dip, and you also can't liquidate because they're not liquid, right? They're something that you just have to potentially hold for longer. Crypto, to some extent, you can also sell it immediately, but the volatility on some of those things are really extreme. There's been many crypto coins that come out, and then they have a big pop, and then they just disappear the next day in some cases. So there's not as much regulation there. So you just have to be aware. I'm not anti-crypto by a long shot, but I think it's not an area that I have expertise enough in. And I would just say it's good, it's important even more so to do your research. Ideally, you can pair with an advisor that has expertise there. But I think things should be appropriately sized, right? So the public markets, we have 200 years of history, and we know that they have kind of mounted a wall of worry, like so many times, right? There's been so many things throughout history, wars and crises, natural disasters, pandemics, everything, and there's a tendency of it to retract temporarily and then bounce back, right? So if that's your core portfolio, I'd support that as the base, and then whatever the magic number is for someone, 30, 40, 50% can be in these other things.
Alternative stuff.
And I really like real estate too, so I think that could be maybe even a bigger portion. Things like gold, maybe it's a small portion, but everyone's going to be a little bit different. But just generally, if that's how I would think about it.
So just really, if I was to summarize, hey, there's obviously the public markets, there's the private markets, of course there's real estate, and within real estate there's a whole slew of options for a lot of people, everything from single family residential to maybe assisted living facilities, for all I care, right? And then there's, of course, the digital assets, cryptocurrency, there's the art, gold, businesses for certain people, like, investing into, like, obviously business. Anything else other than this that comes to, because sometimes you hear people like, what is out there? Like, other than these traditional core type of options, anything else that comes to your mind when we say different types of asset classes?
On the alternative, like, I'm just using the word alternative with a big umbrella. And then under that, there's so many layers. I mentioned private debt, so direct lending is one where a business that wants to, raise money, and they're not public, they might choose to have a collection of investors to kind of borrow from directly. Maybe there's 10 people, and then we're trying to raise $10 million. Can you each give me $1 million, right? So now you have kind of a bond, but it's private debt, right? So that's one. There's direct lending. There's direct kind of private mortgages, right? So it's not a mortgage that is on a public, it's not publicly traded, but there's a huge private mortgage market there,
space,
right? It's commercial, it's residential. It's alternative can get a little bit, but there's nothing else that comes. Those are the main ones. You can get kind of really fancy and go into some really niche areas, which I don't have probably enough expertise in. But those are one thing that I'll bring up as well, which I didn't talk about, is which is usually available for pension plans and institutions only, so it's probably not as relevant, but it's kind of worth bringing up, is this asset class of infrastructure, which is things like large economically essential projects. So infrastructure you would think of as like toll roads, railroads, shipping ports sometimes, even like data centers. It's like these things that are just critical for the economy, and they're putting in a ton of money into it, right? We're hearing about that in Canada, we're hearing about that in the States. We're going to put money into infrastructure, right? So there's ways to invest in those. It's a little bit like private equity. It's a little bit like real estate too. You're buying something physical. That comes to mind.
Are they typically backed by government, like governance kind of thing? Like, is it typically done by private companies per se?
It would be, but it's sort of like In some cases, there's a lot of just government backing behind projects because there's a national interest, right?
Gotcha.
For example, building high-speed rail or something,
Sure.
right? Like there might be subsidies for a private company
Sure.
to go and get out there and build this. And then through the private markets, they would raise that capital,
Sure.
but it's got this backstop of
Sure.
the government's making it easy. Through regulation, the government wants people to invest in things like solar farms and wind farms
Sure.
and charging stations, so there's
Yeah.
a government push there. In Canada, pipelines is becoming
Yeah.
a hot topic
Yeah,
again, so
yeah,
that
yeah.
could be one as well. But those are all kind of infrastructure where it's not that you have a guarantee from the government, but it's just because it's a nationally sensitive and important topic, they just have a natural flow of government money coming in. So that helps from an investment perspective too.
Just something that caught my eye, and I know we've spoken about this quite a bit as well. We don't think about data centers quite a bit at all, but like of course with like AI or any type of things, the technology is driving a ton of change, and whether you like it or not, you need spaces to be able to store those data, and I suppose data centers would be a huge thing,
That's a huge
which
one.
already is obviously, right? And of course, I suppose that'll continue to boom as an asset class just in the long time
I
horizon.
absolutely think that will. Yeah, I'm very AI bullish as a whole. I think that's going to keep going for some time. I started with being an AI skeptic initially.
Sure.
I was like, oh, is this taking people's jobs? But I use it as such a productivity enhancer now. I don't know how kind of involved you are.
200%.
Yeah,
200%,
I'm in and I just use it as everything from fine-tuning my writing and my emails to kind of drafting larger plans to analysis for investments. Like it's a game changer, and it's just starting. And you're right, there's just a huge data need there. So there's going to be more and more need for data centers. So that's going to be a growing area for sure.
Listen, I know we were supposed to talk about quite a bit about wealth preservation, other strategies, and even just like transferring wealth to another generation in a tax-efficient manner. But the reality is, I think we just got right into the building portion of it quite a bit, obviously. So I will probably save that for a different podcast just in general. But before I wrap things up, there's two things that came to mind, and I'm going to go back really to the basics. It's funny because I think I should have talked about this at the beginning, but the importance of financial planning and cash flowing and budgeting and those kind of things, it often is considered a very simple thing, unfortunately. People don't like to budget properly, or families just in general are just caught up with their day-to-day stuff. They don't end up budgeting properly. But we see the ramifications of those things, or the implications of a lot of that lack of budgeting with what's happening in the real estate space currently. Like people are like, hey, the interest rates are crazy high. We don't know how we can keep up. People are losing their houses and things like that from time to time. I mean, maybe not a lot, but people are just generally behind in a lot of things because they don't budget and things like that. One thing that I've always said is, hey, it's great to go out and invest and do things, but make sure that there is some method to the madness, right? Regardless of what we do. Can you maybe just elaborate, touch base on the importance a little bit of budgeting, cash flows, statements, and whatnot?
I totally agree. I think when I start a financial planning engagement, and the hardest question is always, you ask someone how much do they spend every month, and most people don't have a good, solid understanding. And I understand, we're pulling out our card and tapping, and we don't always have the mental accounting of what's actually what's adding up monthly. But it's so important because that's the money out, right? You know what's coming in, you know your paycheck, right? You know maybe what's taken off for investing, but the money coming out is the kind of hole in the boat, right? And that's kind of sinking this thing. So how do we figure out how to have more coming in than more going out? And the budget, it's simple but so important. And there's enough financial tools now to make it easy for people, right? You can download your statements, you can throw it into a lot of apps to kind of do a lot of the legwork for you. So lean into technology nowadays, make it be your friend, and have the starting point be, credits and debits, money in, money out, right? Inflow, outflow. You should just have an understanding of, and then, looking at the expenses, it'll shock some people when they start to look at that in detail and they go, oh, I'm paying for that subscription, which I haven't looked at for 2 years. Why do I even pay for that? That membership, I haven't gone to that place in so long. I signed up for it, and I guess they doubled their cost 2 years ago. I didn't even realize that. Just do an audit on your monthly
time to time, that's huge.
expenses. And get rid of some of those things that are maybe piling up and hidden. And then you can think about, you don't have to necessarily penny pinch and save every single dollar. I don't think that the goal financial planning and the kind of life in general is to like just maximize the end number, right? I just want the number to be so big, right? Like along the way, the whole point was to enjoy your time with your family and to the fruits of your labor and to have
100%.
fun and that kind of stuff too. But you can't also, have that all be at the expense of in the future you've saved nothing.
Of course.
Right. So the starting point is so important. And the other point I'll mention about the planning side is the plan should really plan for a range of outcomes, right? So we might use a kind of a base case as the portfolio grows at 5%, right? And we'll hope that things go that way, and historically they should go that way. But what if it doesn't? We'll do some stress testing. What if it's a 2% rate of return? What if your expenses go up by 25 or 30%? Let's say later in life you have some expenses for long-term care or something, which as you would know is very costly, or anything that would just lead to life getting more expensive. And does your plan still work that way? We might do some probability scenarios of just like, here's the range of outcomes, right? Where you're okay in these ones, you're not okay in these ones. And then you can kind of build up some buffers of, what if rates go up? Am I okay still? How much should I have in liquid assets, in cash? It can kind of drive a discussion about the investments too, right? Like how much should we have in fixed income or in the cash and the safe investments? But the planning is, I think, the starting point. It's so important.
Yeah, because whether you like it or not, people are also living longer now, right? So you want to make sure you don't outlive your retirement funds and whatnot as well. And just even, you want to talk about planning for the next 5 years, 10 years, major purchases, but you also want to make sure retirement and not outliving your retirement lifestyle, and you never want to be able to sacrifice the golden years because you don't have enough cash to be able to live.
So important, like when you were back in the 60s, say, right, if you were hitting the age 65, based on life expectancy, you might live like 10 or 12 more years, right? So you would live until your 70s. So your retirement period was like 10 years. It wasn't as difficult to have your portfolio stretched for 10 years. Plus back then people had defined benefit pension plans, right? The whole world was different, right? Now it's do it yourself, right? The pension world has changed. And also you're going to live an extra 10 years. You're going to live until your, most cases until your late 80s. I was just at the retirement residence down the street here, and there's a lot of people in their hundreds, right, walking around, which, and it's great to see, but it's also, it's hard to think about it as a problem now, but it is sort of it's a problem in a sense, right, because you weren't necessarily planning to have the assets last until you were 100 or 100 plus. So it's something that you should plan for. The financial plan should look at, I'm going to live to 100. Just start with that as a starting point, right? And God forbid you pass away earlier, but let's just assume that you live a good long life. And then now, are your assets okay to stretch through that much longer time horizon?
No, absolutely. I think it's just important to make sure people plan. Like before you jump into something, even as something as simple as, I understand sometimes buying that first home is such an important feeling. Like there's no question about it, but I don't think it should be done at the expense of family not being able to make a lifestyle that's meaningful for their, for the entire family at the end of the day, right? So owning real estate is great, even as a first home. I understand, like, when I just maybe read a stat a couple of days ago, which is the first home for a lot of people now is at the age of 40.
Oh, wow.
So, and again, I don't know the merit of that. I just read it on the passing, but it's just important to make sure if you need that time because you need to have that extra emergency funds, all of the other stuff, buffers before you jump into something, make sure you take that time to jump into it rather than jumping into it and then losing what you might, what you're building as an overall thing.
Yeah, it's all about the risk management, and you would know this more than anyone really, right? But you get into the home and then you kind of planned it based on the way things are today. Like my wife and I are both working and we both have these pretty good jobs, and in this scenario things just sort of work, right? But as I said many times now, life can happen and something happens where it affects one of your incomes, and what if one of you was not employed for 6 months or longer, right? And you're down to one income and rates go up, right?
100%.
Like it's stressful, 100%. But you don't want to get into a situation where I'm forced to sell the home, and that was never the plan. So how do we kind of build a buffer to get around that?
100%. 100%. Mark, it's been a pleasure, obviously, having you on the show. But more importantly, any last few things you want to add, just to as we sort of wrap up, just in general?
No, nothing comes to mind. Like I think the principles about getting invested, staying invested, diversification, I think is so important. Take advantage of those employer plans. Don't overcomplicate things. Keep it simple. Working with an advisor. I'm not to do a plug for myself necessarily, but I think in general, there's a tendency to want to do everything yourself, especially with our generation. I think where we grew up independent, right? But now I'm seeing millennials that are accumulating some wealth, and their life's getting more complex, right? So why not, take a little bit of time away from the spreadsheets and delegate a little bit to a professional and think about things holistically. The planning side of it, the estate planning, what happens after you pass away, insurance, everything else. And then I think, it's just about having a plan and planning, going back to that whole.
I'm a strong believer, you're good at doing something, you're great at doing something, but if financial planning or planning for that isn't your sort of cup of tea, just seek out specialized knowledge, obviously, to be able to make sure that you're looking at things from a very holistic perspective and not just on a silo per se, right? And then of course, I know we didn't even talk about wealth preservation, but wealth preservation is just as important as wealth building. We can maybe do another podcast on it sometimes during the year or next year, but just obviously as people are just building stuff, just make sure you're doing everything you can to preserve what you're building so that you can also pass it down to the next generation in an efficient manner.
Yeah, the multi-generational part of it is a huge thing for families, and
100%.
You built this whole thing up, but the transfer is so important. Getting the next generation educated, right? Having them be competent to kind of
inherit
the money is a huge thing too, but that's a topic for another day.
Yeah, 100%.
Sounds good.
Mark, it's been a pleasure. Thank you so much.
Chen.
Thanks for sharing a lot of your insights with a lot of our viewers as well.
Thanks for having me. Thanks so much.
Thank you.
Great.
It's been a great.
Take care.
Thank you.